The chair now recognizes the gentlelady from Missouri, Ms. Wagner, chairman of our Oversight and Investigations Subcommittee.
Thank you, Mr. Chairman, and thank you all for appearing today to discuss the reauthorization of the flood insurance program, which is, as we all know, set to expire this year in September. This is an important issue for the St. Louis region, and in particular my 2nd Congressional District, which has seen 2 major floods, in fact, 2 500-year floods in less than 2 years. With the NFIP being $24.6 billion in debt, as has been duly noted, it's important to make sure that there are reforms to the program necessary to keep it solvent and continue providing coverage for those who live in the areas that truly need it. To help offset this burden on the NFIP, I believe a strong private market is important for offering consumers more than one choice and giving them flexibility and options, and oftentimes greater affordability in the coverage they are seeking. Mr. Lehman, when the NFIP was created in 1968, the belief was that the private insurance markets lacked the data and the ability to assess flood losses. What's changed in terms of data technology and the market's ability to assess risk since then, sir?
So there's a couple aspects. There is the issue of modeling is the first major answer. Modeling was introduced in the 1980s and has progressed significantly since then. Also in the 60s, you still had a lot of smaller regional insurance companies that had solvency risk and not the deep reinsurance markets that we have today. So the market has changed significantly in larger companies. It is a global industry where risk gets sort of segmented and chopped up and sent around the world, which is a good thing. And keeping risk on our shores is not something that we want to encourage.
Do you believe, sir, that the private capital would retreat from the market in those cycles where there are significant floods, for instance?
There is a noted in the property casualty insurance industry cycle of capacity expanding and rates dropping and capacity shrinking and rates increasing. So that's normal, but it is a cycle. When rates go up, that attracts more capital and it brings rates back down again. So we saw that after Katrina. We certainly saw it after September 11th. We have been in a soft market for some time, so even Sandy did not have the effect of making capital retreat. It has stayed soft all through that.
Interesting. Your testimony refutes the notion that private sector cherry picking, the lowest risk properties, will destabilize the NFIP, which is something we hear often, to be perfectly honest. Can you provide more detail on that? So
I would not dispute that subsidized properties are unlikely to be moved out of the NFIP until they pay risk-based rates. Right? That is true. But it is not the level of risk. There are subsidized properties that are higher and lower risk. There are high-risk properties that pay relatively a lot for the risk that they face, and there are low-risk properties that don't pay enough. So it is a question of, does the risk match the premium? Those where the premium exceeds the risk will be the first to go, but that's not the same thing as cherry picking. The program itself is a high-risk program, and every policyholder in that program presents a potential cost to the taxpayers, which is why on an annual basis it's not actuarially sound.
Will private insurance companies need to take on higher risk properties in order to kind of chase the yield?
They will take on high-risk properties where the high-risk property presents an appropriate return for them. It's certainly what I live in Florida, and that is something we've seen in Florida in the Citizens depopulation program, that high-risk properties, particularly in South Florida, are among the most attractive to the private market.
Which barriers with the NFIP prevent private insurance from entering the market, and how do these legislative drafts today help solve some of those problems, Mr. Lehman?
Sure. So there remains some confusion about what counts for the mandatory purchase agreement. The Ross-Castor language looks to address that. We do think there's still some confusion even with that bill in that the banking regulators have not weighed in yet. We don't know when they will. And so in the interim, we would like that language to be self-executing, so that where a state insurance commissioner decides that, determines that a policy is appropriate, that it will meet the mandatory purchase requirement. That's the top.
My time's expired. I yield back, Mr. Chairman.
Time of the gentlelady has expired. The chair